Alright, I am going to show you how are we going to use these two different costing techniques to prepare our profit statement. We want to calculate the profit. We have to take our sales minus the total cost. Take the sales minus the cost. This is how we get a profit, right? But we know that total cost can be separated in two different functions. We have production cost and non-production costs. We have two different functions here for our costs, right? So when we do these two different costing techniques, it is necessary for us to separate between the production costs and the non-production costs. Production costs are all the costs that incurred in the factory when we do our production. When we convert our raw material to the finished product, or the cost that incurred in the factory, we call it as production cost. That's why we also can call production cost as a factory cost. All the costs that incurred in the factory, we all call production costs. But how about non-production? Non-production will be all the costs that happen, that incurred outside the factory. Once your production has been completed, the finished product will be transferred out from the factory and we will keep it in the warehouse. So all the costs outside the factory, we call them as non-production costs. Most of the time we always say non-production costs are expenses. Alright, so I would like to mention about the example for the production costs. The cost that incur in the factory, the cost that incur when we make our production. Direct material is one of the production costs. Direct labor, the wages, the labor cost that we pay to our production workers, and all the indirect costs that happen in the factory, we call them as production overheads. These are all called production costs. How about non-production expenses? Outside the factory, our syllabus, we have these three. Administration overheads, or you can say administration costs. Then we have the distribution overhead, distribution costs, and we have selling. Alright, when we want to do marginal costing profit statement and absorption costing profit statement, first we need to differentiate between our production costs and our non-production costs. And the next part, we need to separate out the cost behavior for all these costs. Direct material will change according to the production, so direct material is a variable cost. Direct labor is also the variable cost. The more units we make, the more labor costs we have to pay to our production worker. For all the indirect costs that happen in the factory, we have both behavior. We have variable production overhead. We have fixed production overhead. Administration, distribution, selling, this one, all we have both. We have variable type and we have the fixed type. Okay. variable fixed. So if I am going to use the marginal costing, the features here is it is necessary to distinguish between the variable and the fixed cost. Variable cost and fixed cost have to be separated. We cannot put them together. Alright, the variable cost and the fixed cost have to be separated. Although variable production and variable non-production, both of them are all called variable, but because their functions are not the same, we cannot put variable production costs and variable non-production costs together. We still have to separate the variable production cost and variable non-production cost. The reason, when we want to calculate our product cost per unit, only the production cost can be used. When we want to calculate the inventory valuation, only the production cost can be involved. We cannot use the expenses to value our stock. We cannot use expenses to value our inventory. Alright, so that's why although variable production and variable non-production, they are all variable type, we cannot put them together. The first features for marginal costing, fixed cost and variable cost must be separated. Alright, the main thing here is because when we want to calculate the product cost per unit, say under the marginal costing technique, I want to calculate how much, right? I want to calculate how much is my product cost per unit. So say this is the product that I make. This is the product. So now I want to find this product cost. Under marginal costing, the product cost only will be valued at variable production cost. See here, closing inventories, our product, alright, our inventory of work in progress, of finished goods, all have to value at marginal. Marginal is variable. Variable production cost, we also can call it as a marginal production cost. Variable production cost. Look at this diagram. Production cost, but variable. Variable production. That's mean I use this color. These are all variable production costs. I want to calculate how much is the product cost per unit under marginal costing. So the total product cost per unit, the total product cost per unit is equal to variable production cost. So what are included in this variable production cost? You know you have 3 arrows: direct material, direct labor, and variable production overheads. These 3 elements add up together. That is how I get my total product cost per unit under marginal costing. So say, that means I am going to add the 3 elements together: direct material, direct labor, and variable production overheads. Say example, every elements, they are all $1 each. Direct material $1 each, direct labor $1, variable production overhead $1 1 unit. So that's means I just add them up, $1 plus another $1 plus the variable overhead also $1. So that's means 1 unit I make. How much is the total product cost per unit? $3. This is under marginal costing. Alright, this is under marginal costing. closing inventory of work in progress, your finished goods, all were valued at marginal production cost or variable production cost. But how about the fixed? The fixed production overhead will be treated as period cost under marginal costing. Alright, under marginal costing, see, all fixed overhead, including fixed manufacturing overhead, that is a fixed production overhead, fixed manufacturing, fixed production overhead, they are the same. They are all treated as a period cost, and it will be written off in the statement of profit or loss of the period, right, when they are incurred. So fixed overhead will not be used to calculate our product cost under the marginal costing. Under the marginal costing, fixed overhead will be treated as a period cost. But how about absorption costing? Okay, so just look at the notes here. Absorption costing, it is not necessary to distinguish between the variable and the fixed. Absorption costing, the fixed and the variable cost can be combined together as long as they are in the same function. Variable production, fixed production, I can put 10 together. Variable non-production, fixed non-production, they are in the same group, same function. I can put them together, group them together. No need to separate. Closing inventory will be valued at total production cost now. See? Direct material, direct labor, and variable production overhead, they are all called variable production costs. But under absorption costing, I am using total production cost to value my stock. That's mean all this lah. Take a variable, add in your fixed production overhead. So this is called total production cost. So say, come back here. I am going to show you how I calculate the total product cost per unit under absorption costing. So can I just copy all this so I no need to write another round? Control C, put it this side. Okay, so now I change it to absorption costing. Alright, so here we will say the full. So means, make it slightly bigger. I am doing the absorption costing. Absorption costing. So under absorption costing, now I want to calculate the product cost per unit. I want to know how much is the total production cost per unit for this product that I make. I will value it at the total production cost. Total production cost, not just direct material, direct labor, and variable production overhead. It also include the fixed production overheads. That means I have to add in one more arrow. That is my fixed production overhead. So say every elements, they are all $1 each. $1 for material, $1 for labor, $1 for variable overheads, and also $1 for the fixed. So now my total cost per unit under absorption costing, it will be $4 per unit. Okay, I make it bigger for you to see both. You can see the difference between the marginal costing and the absorption costing. Right, you can see the difference. Under marginal costing, when I calculate the product cost per unit, I only can take variable production costs. What are called variable production costs? Direct material, direct labor, and variable production overhead. But under absorption costing, when I want to calculate the product cost per unit, I have to take full. I have to take total production cost. That means all the variable production costs plus fixed production overheads together. So in my example here, I say all the elements, they are $1 each. That's why the total product cost per unit under absorption costing is $4. So based on this concept here, we can have these two conclusions. Under absorption costing, its cost per unit, the product cost per unit is always higher than marginal costing. Marginal costing. This is what we can say. Under absorption costing, the cost per unit, its cost per unit is always higher than the marginal costing cost per unit. The reason, you have one extra elements when you calculate your product cost per unit. That's why the cost per unit under absorption costing always is higher than the marginal. And another one, when you value your stock, inventory valuation under absorption costing is always higher. Is always higher than marginal costing. Why we can say that it's always higher? Because the cost per unit is higher. You are using the higher cost per unit to value the same quantity of the stock, same quantity of the inventory. Definitely, absorption costing will show you the higher inventory valuation. Alright, this is the main difference between the marginal and the absorption costing. Please remember, no matter marginal costing technique or absorption costing technique, we never can use expenses to calculate the inventory valuation. Expenses cannot be used to calculate the inventory valuation. It's only the production cost. Production costs are all the costs that we use it when we do our production in the factory. Alright, so these are all the examples for the production costs. The costs that happen in the factory, that's why we also can call production costs as the factory costs. Alright, so all this you can read through. Absorption costing, not necessary to distinguish between the variable. As long as they are the same function, you can put them together. Alright, closing inventory must value at total production cost. Inventory value using absorption costing are greater than marginal costing because of higher cost per unit. Fixed manufacturing overhead, fixed production overhead are absorbed into cost unit. Cost unit here means the product itself. Cost unit is not your cost per unit. Cost unit here refer to the product itself. We charge our fixed manufacturing, our fixed production overhead, we absorb. We charge the fixed production overhead into the products. Okay, into the products. So fixed manufacturing overhead are charged in the statement of profit or loss of the period in which the unit are sold. That's why, because you charge your fixed production overhead into your product cost. That's why we say this fixed production overhead would be written off in the profit statement when the unit are sold. Alright,